Will rising yields be a bigger problem for the market in 2025? Joining us now, David Spika is Chief Market Strategist at Turtle Creek, and Jeff Kilberg is founder at KKM Financial and a CNBC contributor. Welcome to you both. All right, David, take it. Why are stocks shrugging off this move in rates?
I think what we have to factor in, Kelly, is why are yields going higher? So the drawing on the board demonstrated certain periods of time where yields were going up or down based on expectations for Fed policy and really based on inflationary pressures. That's going to have a big impact on stocks. Most recently, yields have been going up, and your previous guest confirmed this, based on growth expectations. So if yields are rising based on growth expectations, we can get more comfortable around earnings growth. That's positive for stocks. If yields are going up because of deficit concerns, or more importantly, because of inflationary concerns, you're going to see stocks fall. So really, it's a function of what's driving yields. However, I would say that over time, lower yields favor the equity markets, particularly longer duration equities like these mega cap tech names. So that's something that we're going to have to get used to. We're going to have to get prepared for higher, longer term rates, for higher rates across the curve as rates continue to normalize.
Jeff, I like the story of yields are rising for good reasons, and it happened in the late 90s, by the way. The only difference between now and then is that we have huge deficits and we have a big debt pile. And so when yields are hanging out at 5 or 6%, that means interest costs are going to be one of the biggest payments of the U.S. government. It means we're going to keep having deficits. We're going to keep having, growing debt piles. So we can't, I think, be as comfortable with it now as we were back then.
Well, I think you're right, Kelly. I think David laid out the narrative. He's absolutely right. When you see optimism on economic growth, you can see equities move higher with higher yields because that's a strong economy. And I think that was the narrative in 2024. And subsequent to the election results, people got really excited. We talked about animal spirits. But now at 473 in the 10-year, for the first time, we even saw it in the minutes, the markets are questioning, was the Fed right in cutting? If you go back to September, they've cut 100 basis points, and the 10-year note is up over 100 basis points. So I think as the Fed is kind of sniveling today, you're seeing just skittishness. You're seeing confusion. Look at the S&P 500 intraday today, Kelly. We have seen the S&P 500 go positive and negative over a dozen times. There's no leadership. There's a little bit of confusion. The VIX was up another 5% earlier. And for the first time, as we get closer to this 5% level in the 10-year, I think people are considering massive profit taking or rebalancing because 23 and 24 were historic equity gains back to back. So I think at this moment in time, it seems like the 10-year note is going to go to 5%, and that is going to have a little bit of an acute reaction to all these high flyers or these top 10 holdings in the S&P 500, which you could easily argue are way over concentrated.
David, what would you say to that?
Oh, I agree. I think something you have to factor in is what higher rates mean for the equity market. And I think the problem today is that so many people are yearning for the ultra low rate environment we saw in the last cycle. What they don't understand is that to go back to that ultra low rate environment means the economy has to collapse. We don't want that. What we want is normalized yields. Now, it's not going to be an overnight sensation where people wake up and say, oh, okay, I'm okay with a 5% treasury yield. I still want to own equities. You're going to see allocations into bonds and even into money markets as these things happen. But over time, that normalization of rates makes perfect sense. It may skew your portfolio a little bit. You may want to own companies that are shorter duration in terms of their earnings growth prospects. But over time, people are going to have to adjust to a normalized rate of interest across the curve, and that is actually healthy for the economy and for the market.